Hello, this is Brad Harvey with Harvey Investment Management with a special market update after the happenings on Friday, March the 10th, 2023. As most of you probably already know, there's been a lot of news that came out in the press this week and certainly over the weekend about a regional bank in California called the Silicon Valley Bank. This is a commercial bank, relatively small in stature in terms of total assets. I think they fall 16th in the country according to Yahoo Finance in terms of total assets under management. What happened was this bank was buying a lot of money in treasuries with their reserve funds. Now, this is certainly allowed by banks. I'm not an expert in banking. I'm not an expert in banking regulation, but I've done a fair amount of research to try to figure out what happened. Banks take in deposits. They keep some of those deposits in reserve in case they need them. That's according to banking regulation, and then the rest they try to lend out. Banks make money by charging more in interest on the loans that they make than they pay to their depositors. Well, Silicon Valley Bank was investing that reserve requirement maximum, which I believe is 50%, in U.S. Treasuries, and they did this before interest rates started moving up dramatically. Well, as we all know, as interest rates go up, bond values go down. Well, that means that their reserve assets went down in value. Well, you fast forward with all of this and some of the potentially poor management decisions, and there was a run on the bank on Friday. And the FDIC has stepped in, and they've said that they will go to the insurance amounts and start paying people out of that pool. Who knows what this means ultimately for those uninsured deposits over the $250,000 threshold. This is liable to shake the markets quite a bit in the coming weeks. Time will tell. Stay tuned. Does this mean that all banks are unsafe? Of course not. Money center banks and large banks typically don't hold more than 19 or 20% of their reserves in treasuries. That's considered a healthy number. 50%, personally, I think that's pushing the envelope a bit. Keep in mind also that this is not rules that apply to money market funds. Now, there are money market funds that are only invested in treasuries. These are backed by the full faith and credit of the U.S. government, which is different than FDIC insurance. However, money market funds are not banks. They don't take that money and lend out to mortgage borrowers or other interim financing borrowers direct to companies. That's just not what they do. They invest in other liquid securities and semi-liquid securities to get you interest rates. Well, Silicon Valley Bank, they were doing this trying to get a higher level of interest so they could pay their depositors a little bit more to collect more in deposits. Interest rates have gone up quite a lot. It's moved against them. The regulators have come in. I believe that they've made some managerial mistakes and the shareholders are liable to suffer, but we will see what happens. I don't think the federal government's going to come in and bail them out. I don't think they're going to bail out the shareholders, nor do I think that they should. This is a moral hazard, but it's liable to shake the markets to their core. So pay attention, and keep your liquid cash ready to invest. If the market goes off dramatically, remember, at the end of the day, we want to buy low and sell high. I'm not recommending that we go out and buy the banking sector yet. I'm certainly not recommending that we go out into Silicon Valley Bank or anything like that, but we want to stay tuned. Keep that powder dry, but be ready to invest. We want to buy low. So this is Brad Harvey with Harvey Investment Management with a special March 2023 update.